In this video, I'm going to share with you the easiest, most profitable ICT trading strategy. And I've broken this strategy down into 4 simple steps. Hi guys, welcome back to the channel. If you're new here, my name's Liam. I'm a mathematics and finance graduate turned trader, and I've spent the last 8 years trading, investing, and educating within the financial markets. In that time, I've helped hundreds of traders become consistently profitable, and I'm currently funded over $800,000 in prop firm capital. Now, when I first started out, I kept blowing accounts and failing funding challenges. Now, 8 years later, I've learned so much along the way, and I've learned all of these different strategies and tools that I can use to be more profitable in the markets. And so in this video, I really want to share with you everything that I've learned along the way. So let's dive into my simple 4-step strategy that took me from a losing trader to a profitable trader. Step number 1 is identifying daily directional bias. And so why is identifying daily directional bias so important? Because we need to know every single day when we're turning up to the market, should we be looking for longs today or should we be looking for shorts today? And also, so many traders are having problems with identifying their daily directional bias in a simple, easy, and objective way. And you know, for years in the market, 1 minute I was going long, 1 minute I was going short, and I just constantly kept flip-flopping in the market. And so our directional bias will help take all of the guesswork out of it. And so how do we do this in a simple and easy way? I want you to head over to the indicators tab at the top of your screen, and I want you to apply this indicator right here. It's the EMA 20, 50, 100, and 200. So click the indicator, add it to your chart, and then you should be good to go. Now that it is applied to your chart, I want you to double click the indicator, and then you can uncheck the 20. So this is the 20 EMA right here. We don't need that one. We only need the 50, 100, and 200. Okay, so how do we use this in a simple and easy objective way? If the 50 exponential moving average is greater than the 100, which is greater than the 200, this indicates to us as a trader that we have a long daily directional bias. That means that we will only be looking for long positions. If we take this time period and price right here, you can see the 50 exponential moving average is less than the 100, which is less than the 200. So this would indicate to us that we have a short daily directional bias. If the EMAs are crossed over, then we would have no daily directional bias. And so we would not be looking for any positions within the markets. And so this just gives us a very simple and objective framework in order to identify whether we're looking for longs today or whether we're looking for shorts today. And I personally like to use this on the 15-minute time frame. Step 1 was amazing, but if you don't understand step number 2, there is no way that you will ever become profitable. And step 2 is identifying a session-based liquidity rate. Have you ever found yourself turning up to the markets? You think, let's say that the market's going to go higher. So you enter long in the market. What ends up happening is you just get stopped out and then the market continues in your anticipated direction. Well, this is often due to session-based liquidity. And the reason why it's so important is because if you cannot see the liquidity, it's extremely likely that you will end up becoming the liquidity. This was a concept that was made very popular from ICT himself. And this is something that took me 4 years to work out. Okay, so how do we identify session-based liquidity rates? So I want you to understand that we have buy-side and sell-side liquidity resting above and below previous sessions' highs and lows. So for example, we have buy-side liquidity resting above the London session high. We have sell-side liquidity resting below the London session low. We also have buy-side liquidity resting above the Asia session high, and we have sell-side liquidity resting below the Asia session low. So if we are long bias in the market, we're looking for a raid of sell-side liquidity below a previous session low, and then we can look for a continuation higher. So it's very important when you're trying to work out how to use liquidity raids that when you are bullish in the market, you need to see a raid of sell-side liquidity. And vice versa, let's say you're sell bias in the market, you need to see a raid of buy-side liquidity before you can look for a shorting opportunity. And so this is a raid of liquidity right here. And so what this is going to be doing is running all of the sell stops that are resting below the London session low. And this is also going to induce short traders into the market who see this as a breakout to the downside. Step 2 is great, but if you don't understand step number 3, There's no way that you will ever be able to time the market correctly. Step 3 is momentum confirmation. And the reason why a confirmation is so important in the market is because it ensures that you're not trying to catch a falling knife. And I've been trading for over 8 years in the market now. And I've blew so many accounts and failed so many funding challenges, trying to pick the absolute perfect top and bottom within the markets. And so what I realized is we don't have to be first into the market, and we can allow the market to show its hand first. Also, Mark Douglas, the author of Trading in the Zone, argues that a mechanical entry model is the most important aspect to any trading system. And so how do you look for the perfect confirmation? So once you've seen a liquidity rate below a previous session's low, you need to wait for a 15-minute bullish confirmation. And so this could be during a New York kill zone. And so for example, the New York kill zone is between 8 a.m. and 10:30 a.m. Eastern, or the London kill zone, which is between 3 a.m. and 5 a.m. Eastern. We also have the Asia session, which is 7 p.m. until 12 o'clock midnight. But I am only looking at executing during either the London kill zone or the New York kill zone. Okay, so this is an example of an A+ confirmation. And all this simply is a 15-minute bullish confirmation during a New York kill zone. And of course, this has to be after we've raided sell-side liquidity. So if we just zoom in here, you can see this rate of liquidity is quite small, but it is still valid. And so step 3 was incredible, but this step literally ties everything together. And step 4 is entry, stop loss, and take profit. And so why is entries, stop losses, and take profits so important in the markets? So we need to ensure that our stop losses, take profits, and entries are all fully mechanical, they're all fully defined, and they're all fully rules-based. This ensures that our backtesting data is very reliable in the market. And this is also made apparent by Mark Douglas, the author of Trading in the Zone, when he says that trading a rules-based system is the way to long-term consistency. And so how do we enter the market? So I like to enter via a buy stop in the market. This would be placed above the bullish candle high. My invalidation always goes below the liquidity sweep, and I like to account for some spread in the market. So right here, we're looking at the US 500 on the 15-minute time frame. And so down to the low is 12.3 points. And so I would always add a small buffer at the bottom of my trade. And so this brings it to 12.8. Then in terms of targets, I always target a repeatable 1 to 2 risk to reward. And this also further ensures that our backtesting data is very reliable because we're targeting the same risk to reward every single trade. So I was actually triggered long in this trade right here, and I'm going to share with you execution proof and also the live analysis that was sent ahead of time to the exclusive community, just to show you that I'm not cherry picking these trades. And then it was just a case of setting and forgetting this trade. It's either stop loss is hit or take profit is hit for a 1 to 2. And as you can see, take profit was hit during the Asia session for a 1 to 2 risk to reward. And so it's very important that you adopt a set and forget style system, because this allows you to take all of the guesswork out of it. Like so many times I used to find myself moving trades break even way too early, or micromanaging and getting emotional during these drawdown periods right here. And so that is why I like to adopt a set and forget style system. And so just to recap the full system right here. Step 1, identifying daily directional bias. The 50 EMA is greater than the 100, which is greater than the 200, so this indicates a long daily directional bias. Step 2 was identifying a liquidity rate in the market. This was your rate of sell-side liquidity below the London session low. Step 3 was our momentum confirmation. And this is simply a 15-minute bullish confirmation during a New York kill zone. And step 4 was our stop loss, entries, and take profits. So our entry was via a buy stop on the break of this candle high right here. Clear invalidation at the liquidity sweep low. Looking at targeting a repeatable 1 to 2 risk to reward. And there was no micromanaging in this position.